Hey everyone, today we're taking a look at the global tech giant Recruit Holdings, because something pretty wild happened with their latest first quarter results. On the surface, the numbers look like a total contradiction, but if you dig a little deeper, there's a really powerful story here about strategy and efficiency.
Okay, so let's get right to it. This is the heart of the paradox. In their latest quarter, Recruit's total revenue actually went down by 2.5%, but, and this is the crazy part, its operating profit shot up by more than 20%. Yeah, you heard that right. Less money coming in the door, but way more profit at the end of the day.
Right, so this is the big question, isn't it? How is that even possible? It sounds like it breaks the basic rules of business, right? But spoiler alert, it's not magic. It's actually a masterclass in focusing on what works and boosting productivity. So let's break down exactly how they pulled this off. All right, first up, let's really unpack those headline numbers. So you're looking at revenue of roughly 879 billion yen, but at the same time, operating profit jumped to almost 154 billion yen. And here's the kicker. For Recruit, this wasn't some happy accident. They actually said these results were pretty much what they expected and that it was all driven by a deliberate push to improve productivity everywhere.
So where did all that extra profit come from? Well, the answer really boils down to one specific part of their business, their HR technology engine.
I mean, look at this. This segment is the absolute powerhouse of the company. A whopping 63% of Recruit's core profit comes from just one place, HR technology. We're talking about platforms like Indeed here. Their other two segments, marketing and staffing, are much, much smaller pieces of the profit pie. It really shows that where HR tech goes, Recruit's profits follow.
Now, you probably saw that term EBITDA plus S on the last slide. And yeah, it sounds super technical, but don't worry. It's basically just Recruit's favorite way to measure how profitable they are. Think of it as their special lens to see how much cash the business is really generating without all the accounting noise. It's the number they care about, so it's the one we're going to focus on too.
So what's the secret sauce for the HR tech segment? It's pretty simple, actually. They've just gotten incredibly good at doing more with less. They're squeezing every bit of value out of their operations, especially in the massive US market, even when the job market itself is kind of slowing down.
And check this out. Even with fewer jobs being posted online overall, their US revenue in HR tech still went up. I mean, that's wild. It tells you they have become absolute pros at monetization, getting their customers to see more value and, well, pay for it.
And this is the result. A profit margin of 35%. 35%! That kind of efficiency is the engine that's lifting up the entire company, making up for any weaknesses in other areas.
But hey, to get the full picture, we can't just look at the star player, right? So let's take a quick look at Recruit's other business units.
And wow, it's really a tale of two different worlds. On one hand, you've got their traditional staffing business, which is, well, it's struggling. Revenue is down, margins are tight. But then you look at their marketing matching business, and that's a whole different story. It's a real bright spot. Revenue is up over 7%, and it has a super healthy profit margin of over 31%. This contrast just makes the power of that HR tech segment stand out even more.
Okay, so you've got one segment that's absolutely crushing it and another that's kind of struggling. So what does all this mean for the future? Well, it turns out the company is feeling pretty good about things.
This is a big one. Recruit is sticking to its guns. Even with all these moving parts we just talked about, the company hasn't changed its financial forecast for the full year. That's a huge sign of confidence. It's basically them saying, yeah, Q1 wasn't a fluke. This is the plan, and it's working.
And here's what that confidence looks like when you put numbers to it. The company is forecasting that its core profitability, that EBITDA plus S number we talked about, is going to grow by 2.7% for the entire year. So they're not just holding steady, they're predicting even more growth on top of what's already a strong foundation, all thanks to that super high-margin HR tech engine.
Now, this kind of profit and confidence isn't just for spreadsheets and investor calls. It has a very real impact. So for our last section, let's look at how Recruit is turning all this success into actual, direct value for its shareholders.
And they are not messing around. They're taking clear, decisive action. First, they just finished a massive share buyback program. Then, they immediately launched another one. And to top it all off, they've bumped up their dividend forecast for the year. It's like a three-punch combo of returning cash directly to their investors. And to give you a sense of scale here, that buyback they just finished, it was worth 450 billion yen. That is a huge amount of value being pushed directly back to the people who own the company.
And they did not waste any time. We're talking just 2 months after finishing that massive program, they announced another one in August. This shows it's not a one-time thing. It's a consistent, ongoing strategy to reward their shareholders, and it's all possible because of the strong cash flow their business is generating.
And all of this brings us to our final big question. What we've really seen here is a company that decided to focus on profitability and efficiency, maybe even more than just growing revenue for revenue's sake. And now they're seeing the payoff. So it makes you wonder, in this world of economic uncertainty, is this the new playbook for success? This intense focus on a super high-margin, tech-driven core? For Recruit Holdings, it is absolutely working. Thanks for tuning in.